Ever wondered how traders protect their portfolios from market downturns or even profit when stocks fall? Welcome to the world of put options, your ticket to mastering the art of hedging and speculation. Stick around to unlock the secrets of savvy investors. Options trading is a powerful tool in modern finance, offering flexibility and strategic opportunities. Among the various types of options, put options stand out as a favorite for those looking to hedge against potential losses or profit from a stock's decline. In this video, we will break down what put options are, how they work, and the potential rewards and risks involved. Whether you're a seasoned trader or a curious beginner, understanding put options can be a valuable addition to your investment strategy. In this video, you'll learn the core mechanics of put options, including real-life examples of both buying and selling puts. We'll explore scenarios demonstrating how traders can benefit or incur losses based on market movements. Additionally, we'll discuss why traders use put options for speculation, hedging, and income generation, and delve into the inherent risks involved. By the end, you'll have a clear understanding of how to incorporate put options into your trading toolkit effectively. Options trading is one of the most versatile tools available in modern finance, offering unique opportunities for both hedging and speculation. At the core of options trading are two primary types of options: calls and puts. While call options give investors the right to purchase an asset, put options grant them the right to sell an asset. Put options are particularly appealing to those looking to protect their investments from downside risk or to profit from a decline in a stock's price. This video will explore the intricacies of put options, examining how they operate, their potential benefits, and inherent risks, along with realistic examples to demonstrate their application in real-world scenarios. First, let's define what a put option is. A put option is a financial contract that affords its buyer the right, but not the obligation, to sell a specific quantity of an underlying asset, like a stock, at a predetermined price, known as the strike price, by a specific expiration date. For instance, buying a put option for shares of Company X at a strike price of $95 ensures you can sell those shares for $95, regardless of market price swings. If you are the buyer, you gain value as the asset's market price decreases. Conversely, if you are the seller or writer, you are obligating yourself to purchase the asset at the strike price, should the buyer decide to exercise the option. This has potential profitability if the market price remains above the strike price, but can lead to losses if the market price falls significantly. Let's walk through a practical example of buying a put option. Suppose you anticipate that shares of Company X, currently valued at $100, will decline. You purchase a put option with a strike price of $95, paying a premium of $3 per share, amounting to $300 for 100 shares. If the shares drop to $85 by the option's expiration, you can sell at $95, reaping an intrinsic value of $10 per share. After accounting for the premium, your profit would be $700. Conversely, if the shares remain above $95, your option expires worthless, and you incur the premium loss of $300. This scenario highlights that while buying puts can deliver substantial returns if the stock drops significantly, your risk is limited to the premium paid. Selling or writing a put option operates quite differently. Assume you're interested in acquiring Company X shares if their price decreases. The current share price is $100, and you write a put option with a $95 strike, receiving a $3 per share premium, thereby securing a $300 income if the shares don't fall below this price. If the shares stay above $95, the option expires worthless, and you keep the entire premium as profit. However, if the shares plummet to $85, you must purchase them at $95, incurring an effective share cost of $92 after deducting the premium. In such a case, continuous market declines lead to mounting losses. Thus, while selling puts can be lucrative if prices stay flat or rise, the strategy can expose you to unlimited downside if prices fall sharply. Put options serve various strategic roles in trading. They are a favored tool for speculation, offering leveraged exposure to declining markets, and are used for hedging to protect against potential losses in an investment portfolio, much like an insurance policy. For example, if you own stock purchased at $100, acquiring a $95 put minimizes downside risk. Moreover, selling puts is a common income-generating strategy, especially among long-term investors, as it allows them to collect premium income while potentially acquiring stocks at discounted prices. However, both buyers and sellers must be aware of risks. Buyers may lose their premium if the stock doesn't drop, and sellers face substantial risks if a stock's price falls drastically. Therefore, understanding the mechanics, benefits, and risks of put options is crucial before launching into trading strategies. In conclusion, put options, when used astutely, can be a powerful component of an investment or trading strategy. While they provide opportunities for both hedging and profit through market declines, they also bring risks that must be thoroughly understood. Beginners in options trading should consider starting with buying puts due to their limited risk profile before venturing into more complex actions like writing puts. Regardless of your approach, mastering the mechanics, weighing the risks carefully, and implementing solid risk management are essential steps to successfully navigate the world of put options trading. We've covered the essentials of put options, from their basic definition to practical examples of buying and selling these financial contracts. You now know how put options can provide leverage, act as portfolio insurance, and even offer a cheaper entry point into quality stocks. While they offer significant opportunities, it's crucial to be mindful of the risks, such as losses due to time decay or unfavorable stock movements. Remember, successful options trading relies on thorough understanding and strategic risk management. Are you ready to dive deeper into options trading? Start by applying what you've learned about put options today. Consider how they might fit into your current trading strategy. Have you ever used put options before, and if so, what was your experience? Share your insights or questions in the comments below, and let's spark a conversation about leveraging these powerful financial tools.